It's Friday, August the 2nd, so we are saving the most sexy, hot area to be in for today because there's nothing sexier than having a bond discussion.
It is a really, really good discussion. It's going to be a good month. I'll speak personally. My wife and I are expecting
Right.
our first daughter. We had a celebration this morning, very nice,
Thank you.
that HMC gave. We had a mini baby shower, and we're expecting our daughter here later this month. But back to the market
Yes.
and what is always sexy to talk about.
Right.
Obviously, a bit of sarcasm there is bonds.
Right. So we made a decision back in January I think it was January, to get into longer duration bonds in anticipation that the Fed would be lowering rates, right? We looked kind of silly for about 6 months because interest rates didn't go down. It looks like they're going to be going down in either August or September with all the new information that we've received just today. But that being said, that play that we made in January with the longer term duration bonds is starting to pay off. And why don't you get into what we're talking about? And then you're going to talk about the positive places to be from a bond standpoint. And I'll talk about.
Correct. So some of that information that Gib mentioned was that has come in. Payrolls are underestimates. Unemployment has ticked up now. Beginning of the year, it was in the 3% range. Last month, 4.1%. Just this morning, August 2nd, came in 4.3%. While that's not great for us as citizens, the Fed and the Federal Reserve is getting accomplished exactly what it wants, and that's a slowing economy. Therein lies the opportunity in longer duration fixed income. Now, you need to be selective, and Gib will talk about areas to not be in, and please call us if you have questions of where opportunities are. But by going out longer duration, by extending that in good fixed income assets, you can lock in a yield. And then if you lock in a yield that was 5% and now rates are 4%, depending on the duration of time that bond is, so if it's 3, 5, 10 years, whatever that is, you can pick up that capital appreciation. And just as an example, the 10-year Treasury was at 4.5% a month ago. This morning, shooting the video, it's at 3.8%. And I know you always say, that doesn't sound like a whole heck of a lot, 70 basis points.
But in the bond world, woof,
exactly.
it's a lot.
That is a lot. And so different areas of the market in that space, just in a month's time, are up 5 to 7% when we've seen the overall stock market, S&P last 30 days is down about 2.5%.
And today's going to be a big down day, it looks like, because of reports that came from big companies that did not fare very well. Where to maybe make adjustments, and we're still in the process of looking at how much do we want to make these adjustments, because the longer end is going to be a better place to be. The shorter end, where we have the vast majority of our treasuries right now, are going to be the place not to be. Because when you look at a chart of where they are currently, you can see nothing but the ability for those shorter terms to go from where they are at 5.2% on a 3-month down very much lower than that in the short term. So we're going to make some determinations next week of how much to be moving out of the short end and into the longer end so that you can get a better yield and you can get some NAV play, meaning the price will be going up.
And just for our clients, and we know we've talked about treasuries quite a bit, those short-term treasuries that we hold and have looked at, you're still not going to lose a significant money. That's not the issue. It's more the opportunity cost, and can we get a better return now that rates are coming down?
So one thing that we'll be doing is we're going to be changing the shorter end. We just don't know how much and into what. But that will be coming. We have 2 or 3 choices, and we'll be talking about that early next week in our meetings together, and then begin to make some determinations. So with that, the longer end is looking even more promising. The shorter end, which has had an unbelievably good run for your portfolios, is probably starting to lose some steam. So we'll make some adjustments, and we'll make them rather quickly next week. So always remember, it is your money.
And your money matters.
Have a great weekend.